What if you could own a tiny piece of the companies you love, like Apple, Nike, or even your favorite local business, and actually get paid for it? It sounds almost too good to be true, but it's the fundamental idea that has built incredible wealth for millions of people. So, how does this actually work? Well, let's find out. In this video, I will cover why stocks exist, the two ways you get paid owning a stock, the pros and cons of investing in stocks, and at the end of the video, I'll be sharing if this is a good investing option for beginners. First, let's pull back the curtain on something most people just accept without question. Why do stocks even exist? In the next 90 seconds, I'm going to show you exactly how a private company can go public and why they would want other people to own a piece of their business. Imagine a very successful local coffee company. They have a loyal following and make the best coffee in town. The owner wants to expand by opening new stores in other cities, building a mobile app, and creating a bigger brand. To do that, she needs a lot of money. She could get a bank loan, but that means taking on debt that she has to pay back. But there is another option called an initial public offering, or IPO for short. This is the moment the company decides to sell off small pieces of itself to the public. Each tiny piece is called a share of stock. Usually the initial sale is made to affluent professional investors that have a deep understanding of valuing businesses to determine the right price. You can think of them like the wholesalers that purchase a large amount of stocks for a very competitive price. These wholesalers will then trade those shares with other institutional and retail investors on the stock market. And that's the big reveal. When you buy a share of that coffee company, you're not just getting a digital receipt, you are buying actual ownership in that business. The company gets the cash it needs to grow and build those new stores, and in return, you get to own a piece of its future. That's the fundamental reason stocks exist. It's a powerful exchange of your investment for a stake in a company's potential success. So, you own a piece of a company. Fantastic. But how does that actually translate into money in your bank account? There are two fundamental ways stocks can pay you, and I'm about to break them down with a simple analogy you won't forget. Let's go back to our coffee company. Business is booming. The first way you get paid is when the company decides to share its profits. At the end of the year, they have extra cash, and because you're an owner, they can decide to send some of it to you. This payment is called a dividend. It's like a cash bonus for being a loyal investor. The second and often more powerful way is when the company itself becomes more valuable. Because everyone wants their coffee, the business grows, revenue and profit increase, and its reputation soars. The tiny piece you own is now in high demand. If you decide to sell your share, someone else will likely pay you much more for it than you originally did. And there you have it, the two primary ways to make money with stocks. The first is dividends, which is the company distributing its profits directly to you, the shareholder. The second is capital appreciation, the increase in your stock's value over time. You realize that gain when you sell your shares for a higher price. One thing to point out is that it's ultimately the company's decision if it allocates money to dividends or reinvests it into the business to expand and increase the stock price. But they will inform shareholders in advance about any changes. This all sounds pretty amazing, but we have to be realistic. Investing isn't a guaranteed path to riches. So before you invest your money, let's talk about the real pros and cons that every single investor needs to understand. Let's start with the biggest pro, the potential for growth. Over the long term, the stock market has historically been one of the most powerful tools for building wealth, far outperforming traditional savings accounts. But, and this is a huge but, that growth is not a smooth straight line. The biggest con is the risk. The value of your shares can and will not only go up, but also go down. The company you invest in could struggle or even fail, and you could lose the money you invested. There are no guarantees. So here's the honest truth. The pro stocks offer unmatched potential for your money to grow over the long term. The con, this comes with the very real risk of loss and requires patience to handle the market's ups and downs. The core of successful investing is understanding this trade-off. You accept short-term risk for the potential of much greater long-term rewards. So now you know why stocks exist, the two ways they can put money in your pocket, and the fundamental risks and rewards you're balancing. Now, if you're an investing beginner, I don't recommend investing in individual stocks, as it requires good business knowledge and a lot of analysis to go through a company's balance sheet and strategy and compare it with other companies in the same sector. I'll cover better suited options for beginners in the next videos, so stay tuned for those. If this video was helpful, please hit that like button and consider subscribing if you want to see more content like this, and let me know in the comments what you want me to break down next. Thanks for watching, and check out the next video to learn more.